expanding your portfolio using the trust setup, right? The unit trust or a family trust, whatever. I've seen a few different setups, right? You need to talk to your accountant. This is obviously not financial advice. This is just general in nature. I rely on experts to give me their opinion as well, but they do help with asset protection. So if you're in a very litigious sort of a job where you fear getting sued, putting one of these properties in that will protect that asset should you ever be litigated against, right? But also trust can provide good serviceability. A lot of people are using trusts for their, for the serviceability aspect when scaling their portfolios. And it is working really well right now for a lot of people. But use it whilst you can. I have a feeling at some stage in the coming years, they will close that loophole where they will stop allowing that sort of borrowing power that people are getting through trusts. I think they'll limit that eventually. But hey, I don't have a crystal ball and I don't know the future. If I did, I'd be playing Powerball, right? Every week and I'll be winning. But look, utilize them while you can. Get the appropriate legal advice and get a good accountant. Everything comes down to having the right team, right? So yeah, it's super important to get that set up, but everything plays a role. Now, purchasing in an SMSF. So setting up an SMSF, like setting up a trust, you got to talk to your accountant, your financial advisor, get that set up, and your money is better. Actually, this is good. That's kind of a statement. I don't want to be giving any type of financial advice, but I believe it's better in real estate than the stock market. And, buying property, I've seen and been a part of so many purchases in SMSFs where they have outperformed the regular industry super funds where the majority of Australians have their money invested, right? Property has been incredibly powerful at creating wealth over the last few years, and setting up an SMSF isn't super difficult, right? You've got the team that will do it for you. I'm sure the majority of you have accountants that could take care of this. If you need some, by all means, get in touch, but you can get it set up for only, a few $1,000s, and it'll take a little bit of time for you to roll over all your funds into your SMSF and then go to your mortgage broker and get finance and get your finance approval and buy yourself an investment property in a good area based on the data, and you leverage into a larger asset. So you're buying more, you're buying a larger asset value than you would have had in the stock market anyway. But yes, a lot of people have been way outperforming the stock market in recent times. So definitely SMSF is one of those where you can get that extra property, right? So you buy your principal place of residence. If you choose to rent vest first, that's obviously ideal, but you could buy a principal place of residence, put a few properties in your trust, and then you can use, as you tap out of those, a lot of people go to SMSF and then roll all their SMSF industry super funds into their personal SMSF that they've set up and that they're managing, and they buy another investment property. And yeah, it's a great way to invest. And I mean, you can do so much with your personal SMSF. It doesn't necessarily have to be property, but property is our game. And if you use the data to your advantage, you will make some great money. Increasing rents and income. So there's going to be a stage if you haven't used the trust to your advantage, but you could tap out on serviceability, and you are going to need more income, whether that's your personal income or you might have some equity, and you may want to create another income stream, and that could be a granny flat, right? You could be looking to granny flat a property. You could be looking to add something to the property to increase the rent, whatever that may be. There's a variety of strategies that you can use to increase rents. We do it all the time. The dual living or dual income, as I was just chatting to someone earlier, a lot of people in Queensland I'm seeing here are renting out rooms individually and having extra yield, extra income on that property because they're running a co-living setup. Right. So, the type of property that I'm talking about might rent out for $600 or $650 a week. Right. But in a co-living setup with a good property manager, they're getting $900 to $950 for that 3-bedroom. So they're increasing their yield, and the property's positive cash flow. So, there's a whole bunch of ways you can increase yield, but yeah, definitely worth looking into, because no one wants to pay a huge negative out of their wage to support their property. Each property should be as close to standalone as possible, and the portfolio should be working for you. You shouldn't be working for it and slaving away, paying huge negatives and sacrificing your week-to-week lifestyle for that property. That's definitely a no-no. Compounding growth happens over time. So to give an example, right, I've got one of my clients came into the market with $43,000, right? And they've got $600,000 equity 2.5 years later. So from that small deposit, buying in the right markets with data, they've leveraged into a second property, and they've got that much equity. It's not funny. All from, just starting out. And they did use LMI. LMI is one of those things that's super important. Like I said, it's a cost of doing business. But the compounding growth of that, I mean, if you put that $43 in the stock market for the last 2.5 years, I don't know what you'd have, but it wouldn't be a lot. And it definitely wouldn't be, over $500,000. So compound growth over time for that client. He's looking to buy more now, and he should hopefully have a $5 million portfolio at some stage in the next couple of years. So, and then over time, that $5 million portfolio across, another 3 cycles go to 10 million. 10 million will go to 20, and 20 goes to 30, and he should be retiring at roughly at that point. So $30 million portfolio with minimal debt, sell some of it and down pay it. The benefits of compounding growth over time and delayed gratification in real estate is absolutely huge. The problem is a lot of people don't see it through to the end. They will make mistakes. I've regretted so many properties that I've owned and sold. Delayed gratification is key in real estate, and it pays off more and more the more you hold.